The value of our currency is being repriced right before our eyes. This is a chart of gold that has been flipped around, and it helps us visualize the US dollar's complete collapse against gold. Essentially a rock that has no yield, no return on investment, and no significant use case in the real world apart from jewelry. This isn't the first time in history where the US dollar has been repriced like it is today. Between 1999 and 2011, the US dollar lost 90% of its purchasing power against gold. And rewind a few decades earlier, between 1970 and 1980, the US dollar again lost 90% of its purchasing power against gold. But the most concerning part of all this is not the fact that the US dollar has lost 99% of its purchasing power since the 1960s, but it's the implications that this repricing has for the economy. You see, if we flip back to a regular historical chart of the price of gold, we know with hindsight that periods where gold prices rise in a secular fashion like it is today are typically associated with systemic economic issues. The 1970s were marked with multiple severe economic crises along with double-digit inflation, and this secular rise in gold prices in the early 2000s encapsulated the dot-com bust, the Great Financial Crisis, and the European debt crisis. Now, today we actually have a leveraged long trade on the price of gold with our members at bravosresearch.com. We initiated this trade on the 25th of August, and it's currently up almost 20%. I'm also very proud to say that we've been riding the entire gold bull market since 2023 with many trades on precious metals and precious metal miners with our members. The point is, I think we're in a good position to talk about exactly what is going on with gold today and what it means for the economy. The best way to understand gold's macroeconomic implications is to simply overlay the US unemployment rate on top of it. Because if we zoom in on the 1970s, for example, we see the trend that we discussed earlier in plain sight. Large appreciations in the price of gold tend to coincide with moments where the unemployment rate in the United States is also experiencing a long-term uptrend. Between 1969 and 1982, the unemployment rate moved from 3.5% to 10%, the highest level since the Great Depression. And between those two moments, the price of gold rose by a factor of 20. Then from 1982 till 1999, the unemployment rate dropped from 10% all the way back to 4%, which was accompanied by a structural decline in the price of gold. That is until unemployment once again began to rise from 2000 till 2011, which was once again accompanied by another large rise in gold prices. And we can actually go one step further and say that a rising unemployment rate actually leads a rise in the price of gold. If we come back to our chart of the 1970s, we see the same pattern. The unemployment rate began to rise before gold prices, and once again in the mid-1970s. In fact, we can rewind all the way to the 1930s during the Great Depression to check if this holds up true. Back here, the unemployment rate rose from 2% all the way to 25% between 1930 and 1932, and a couple years later, gold was repriced. And there's a very good reason for why it works like this. The way the timeline usually plays out is that first the economy weakens and people lose their jobs. This is followed by a response from the government and the central bank in order to cushion the pain of the recession and avoid deeper societal problems as a result of job losses. The central bank lowers interest rates in order to stimulate the economy, and the government increases its spending, widening the deficit. Both of these responses make both the US dollar and US Treasury bonds less attractive to investors. Cash and bonds are supposed to be a storehold of wealth, providing a return on investment for investors. But when the government spends more, it increases the supply of cash and bonds, which reduces their scarcity and so decreasing their value. And when the central bank lowers interest rates, it also reduces the return on investment of cash and bonds, making them less attractive. And so these responses naturally push investors to flock away from cash and bonds and instead to move towards assets like gold. Gold does not have a return on investment, but at least the US government can't produce more of it, and so it's more likely to keep its purchasing power while the government is increasing its spending. Now, by this point in the video, you might be confused. Gold prices have been going parabolic here, and yet the unemployment rate in the United States is reportedly at just 4.3%, which is low by historical standards. So right now, it seems we're not following that typical timeline that we just discussed. There are three things that are happening right now that explain this. Firstly, we have a global backdrop of increasing uncertainty in regards to geopolitical stability and global economic policy. Just over the course of the last few years, we've seen military conflicts breaking out and many world powers adopting increasingly isolationist policies, we're quickly seeing the fabric that has been holding international relations and international trade together over the last 60 years become a lot more fragile. And naturally, this is pushing governments and central banks around the world to diversify into safe haven assets like gold that are not vulnerable to being manipulated, seized, or frozen by a foreign government. We can see this trend quite clearly by looking at how much gold represents as a percentage of global international reserves. Since the end of World War II, the general trend has been that global international reserves of gold have declined as we had more confidence in international stability. Over the course of the last decade, we've seen this begin to shift in the very opposite direction. And we're seeing this reflected in more granular data. The amount of inflows into Chinese gold ETFs reached record highs just a few months ago. All of this has made gold rise ahead of the typical timeline that we mentioned earlier, but it's probably insignificant relative to the other two things that we're going to take a look at. The second key factor to consider is that the US government and central bank have both already been adopting policies that are devaluing the currency. The US government has been running a larger budget deficit over the last 5 years than at any other point in history, and at the same time, the Federal Reserve, the US central bank, has already been cutting interest rates over the last year, and it's projected to continue cutting interest rates over the coming months. These are exactly the two policies that we mentioned earlier that are typically implemented in response to economic weakness and that lead investors to flock away from cash and bonds and into gold. Now, again, typically these occur in response to a rising unemployment rate, but today they're doing this while the unemployment rate is still quite low. But there's a very good reason for why this is happening. Even though the unemployment rate is low, the average American has been struggling. And we can see this from the University of Michigan's Consumer Confidence Survey that has been hovering at very low levels for the last 3 years now, levels comparable to the low confidence seen at the heart of the Great Financial Crisis. In fact, if we flip the unemployment rate around, we see that typically consumer confidence and unemployment are very interconnected. Low readings on the Consumer Confidence Survey correspond to high levels of unemployment. Today, high cost of living, housing unaffordability, wealth inequality, and extreme political polarity are all keeping consumer confidence very low. And when households feel squeezed, the path of least resistance in Washington, D.C. is to keep on spending. Dialing back on government spending at a time when consumers are struggling would lead to even more pain and political disaster. And so in this environment, deficit spending is the strategy that both Biden and Trump administration have adopted, which has pushed investors to flock to gold without even needing to see the unemployment rate rise. Now, the third factor, and probably the most important one, is that all of this could get a lot worse from here. The goal of this video is not to be alarmist. We're just trying to paint an accurate picture of what we think is happening here. The goal of this video is to provide real facts, real data on a story that most media outlets are just not covering. Let's come back to the chart showing consumer confidence in the US and overlay something called the S&P 500 to gold ratio. This ratio measures the performance of the US stock market against the price of gold. As you can see, throughout most of history, the two lines have generally moved together. As the economic outlook improves and people become more confident, you tend to see stocks outperform gold. On the flip side, as the economy deteriorates and consumers become more pessimistic, stocks tend to underperform gold. Today, although consumer confidence is again at similar levels to the heart of the Great Financial Crisis, the S&P 500 to gold ratio is still surprisingly high, roughly at the same level it was sitting at pre-pandemic. In other words, investors haven't really fully priced in the consumer weakness that we have today. If we add recession bars on top of this chart, we understand why. Each of these big declines in the stock market to gold ratio has coincided with an official economic recession, or in other words, moments where the unemployment rate goes up. Today, although consumer confidence has been very low, investors are looking at the low unemployment rate and seeing nothing wrong. Let me put it slightly differently. Even though people are struggling today, and most Americans living paycheck to paycheck, most people still have jobs. And according to Wall Street, that's a healthy economy. But what happens when the economy actually goes through a recession and these people that are already struggling lose their job? What kind of response from the government and the Federal Reserve will be required in order to revive the economy? So gold's meteoric rise today not only reflects the current macroeconomic conditions that are very favorable for it to move higher, but also potentially an anticipation of even more favorable conditions to come for gold in the near future. We saw something quite similar happen between 2005 and 2008. These were 3 consecutive years prior to the onset of the Great Financial Crisis. You could argue that one could make the case that gold investors were anticipating that a severe recession was going to follow as a result of the housing bubble. bubble. And what's very interesting about this period is that for a couple of years, the stock market was rising alongside gold. Investors only began to sell their stocks when they realized that the job market was breaking. Fast forward to today, and we're also seeing stocks rise alongside the price of gold. There's no sign for now of this coming to an end. And as we've talked about in our recent videos, we actually think that stocks have more upside in the months ahead. But we do think that gold will continue to outperform stocks, and eventually we'll see a divergence take place between the two. This is something that we're looking at very closely with our members at Bravos Research. As I mentioned earlier, we've been long on gold throughout pretty much the entire bull market. It's allowed us to make a lot of very, very profitable trades over the course of the last 2 years. And as I mentioned earlier, we're continuing to ride this trend this very day. If you want to learn how to actually make these kinds of profitable trades on the market, make sure you sign up to our service. We show you our entire thought process, our entire trading strategy, and go through each and every one of our trades step by step with you. I look forward to seeing you on the service. Thank you for watching.